Any type of trading is a challenging and dynamic field that requires a combination of skills, strategy, and discipline. And in the journey of milking the markets as a trader over the last 30 years, what follows is some of my experiences from those 30 years with some lessons that we can both benefit from, even now as a seasoned trader and if you're a brand new trader. So let's look at 7 lessons that I've learned from milking the markets as a trader. Let's do this. Ahoy there, trader. It's Phil, and welcome back to the Anti-Investor Stocks and Options Trading Podcast, where we talk about what really works and consistently wins at trading the financial markets. My goal is to give you the right rules, the correct tools, the software to assist you, a community to support you, and if you'll allow me to be a mentor to show you the right way so that you get real results in the fastest and smartest possible way. Now then, let's get into it today. 7 lessons that I've learned. It's one of those things. There's lots of lessons, but they can all be kind of cousins and branched off from each other. But, here's the headlines of what I've learned when trading. The big one for me is don't trade every day. You don't need to trade every day. I thought you did, but it turns out you don't. The market doesn't always present opportunities every day. There is something to trade every day, but whether it's right for your strategy is the big question. So identifying what conditions are right for your style of trading is more important than trying to trade or feeling compelled to trade every single day. Next up is adapt to market changes. Markets do change over time. They generally all play the same tune over a long period of time, but the ebbs and flows back and forth, they do have a slightly different tempo on a day-by-day, week-by-week, month-by-month basis. So just recognizing those changes in the market environment, that they're either better or worse or more conductive to your trading strategy, is important to recognize. I often talk about my 6 money making patterns, and this helps me to adapt to those market changes that I like or favor for my trading strategy, and whether I'm trading the trend, buying the dips, selling the rallies. If we're in a range, recognizing that we're in a range, we can buy lows, sell range highs, break a range highs, break a range lows. Again, 6 money making patterns. The 2 dark horses, the ones that don't really do, are counter trend, but you still need to know what the trend is. And again, just having a structure and a framework so that you can go, oh, actually, this chart, this stock, this time frame is in an uptrend. I should be buying the dip. Set realistic goals. I've never really set money goals. If I make X thousands of dollars today or this week, I let the market give and take. I don't know which trade is going to work. No one knows which trade is going to be, bunny fingers time, the one. So I have to apply consistency with my trading methodology so that I'm on the trade when it's the one. Again, I'm going to stick with this racehorse metaphor that I've had in the last few podcasts. I could saddle up a thoroughbred racehorse and it just gallops. It's in the lead. It goes straight to targets. And that does happen. I don't know that that's going to happen on this next trader. I do know that it doesn't happen on every trade. So I want to be in the game. I need to be in the race. I don't mind whether again, to stick with the horse race metaphor, I don't mind whether I place first, second, or third. It doesn't matter. As long as we cross the finish line, I still get paid. So it's all about being in the race and crossing the line. And it doesn't matter how we get there, as long as we get there. So again, set realistic goals. Having this crazy 10-to-1 risk-reward ratio, it doesn't happen every day. What gets more money, or what puts more money in my pocket, is, again, to switch to a baseball metaphor, I'm not going to shoot for home runs every trade, every day. What's more realistic is the Moneyball approach. I'm going to get on base. I'm going to get first and second bases dozens of times. And then as long as I'm in the game and I'm swinging for the ball, there's going to be a time where, holy shit, I hit a swing for the fence. I wasn't aiming for it, but you're just going to strike it lucky from time to time. And you're going to be on the 10-backer. You're going to be on the big win. But having an unrealistic expectation that it happens every day is going to be a recipe for disappointment. Also, again, just having those daily goals, weekly goals, monthly goals. Again, if we're in the real world of business, aiming for 10 customers, 10 sales a day, you don't know if you're going to get 10 customers today. So why are you setting a target for, I need 10 customers today? If no one, If the weather's horrible, there's a howling gale, there's a hurricane sweeping through, you're not going to get any customers. So why do you think that in trading? So again, just have realistic goals, realistic expectations. There's lots of parallels in the real worlds that you're already familiar with. So just draw on those. Again, the easiest thing to do is go and look at the business side of the ledger. Managing risk. Control your risk by defining how much you're willing to lose before you place the trade. Knowing where you're getting in, where you're getting out, when it's going wrong and when it's going right is important. You want to know all of those things before the trade goes on. Have a clear exit strategy so that you're not holding and hoping and you become an accidental investor. Journal your trades. Journal, analyze trades, I call them after action reports, but basically you want to look at the trade. Did it do what you think it was going to do before, during, and after the trade? Did you follow the trade plan that you devised? Did you deviate from the plan? Is there a reason why you deviated from the plan? All these things go into journaling and analysing. We want to be very self-critical of what we're doing so that we can get the most out of our own performance and not just the trade's performance. So tracking that performance and the metrics, such as the basics, win-lose percentage, average win-loss ratio, we might be able to identify that 10-bagger. You might be able to find out, okay, well, this is the conditions that surrounds the better quality trade, the A+ trades. And you're only going to find those things out if you're journaling and analyzing trades so that you can then develop playbooks. So you can start to categorize your trades. You can have different money-making strategies. You can have different entry strategies, exit strategies, and criteria. That helps you structure an approach that is the right tool for the right job, the right setup for the right market condition. Again, I talk about the 6 money-making patterns. That helps me identify the market condition so that I can go to the right list of plays that I have available to me for trending, buying the dips, selling the rallies. And then is it a momentum trade? Is it a breakout trade? Is it... insert your own criteria for that part. But you get this little encyclopedia of trading strategies when you do that. Lastly, probably the most important, manage your emotions. I would also diarize your emotional state of mind before, during, and after trade. It's one of those things that is easy to describe, but easy to forget at the same time. You should manage emotions. You should keep them in check. And some people just have a natural ability to do this, which is great. I personally didn't. So what I want to do is I want to be able to manage my emotional state of mind. I often talk to my group of traders as, well, the decision that I'm making now, it's not really to manage the trade. It's just to manage me as a trader so that I've got the ability to stay in the trade or keep the trade or place the trade in the first place. So I'm looking to try and manage me as a trader with a lot of the decisions that I make. Again, practically the strategy works, but sometimes our emotions get in the way. We're excited, we're exuberant, we're sad, we're unhappy, etc., etc. All these things impact our trading decisions. So we want to be able to manage them effectively so we can make sensible decisions. The simplest way to do this is to reduce your position size. Imagine your position size like a volume dial on a stereo. You've got the devil and the angel on your shoulder. Hey, just do this. Hey, just do that. This tug of war of do this or don't do this type of conversation that you have with yourself. Positive talk, negative talk in your own mind. And just imagine like a position size as a volume dial to that self-talk, the self-doubt, or even the overconfidence. It turns the volume dial down so that you can ignore the overconfidence and the self-doubt and self-talk that, yes, this is the one, let's saddle it up and let's ride it off into the sunset. Maybe you've missed something, and just allows you to, keep your emotions in check, reduce your position size, and analyze the opportunity with the consistency and structure that you should be applying to your trading approach. Again, it should be a pre-flight checklist. Has this, and this happened? If yes, place the trade, or if not, ignore it or wait for the next condition to be met. So these are, again, some very high-level overarching things. They're cornerstones to my own trading. And we need to apply them on a regular, daily, consistent basis. This is what is going to make you a long-term successful trader, as opposed to just being short-term lucky in the markets. So if you like what you heard today, be sure to follow and listen from the very first episode where I map out one of my very profitable trading strategies. It's essentially buying the dip. If you go back just a few episodes, I think it's 57, around the 50s. You've got my 2024 trading strategy. It's my latest SPX system. I describe it in there. That is my primary strategy now. Again, moving forward, just because, hey, it's the best thing I've ever created. So if you want to know a little bit more about that, go back to that. If you've got questions, shoot me a message over to phil@antivestor.com, and you can go to antivestor.com to check out any of my trading strategy systems or mentorship programs. If you've got questions, again, send me a message. I've always got time for serious traders who need some assistance. At the very least, I'll point you off in the right direction, because what I do isn't right for everyone, and that's fine. I'll always try and find you the best thing that you're looking for what you want. Again, the example that I like to give is, again, I'm not an investor. I'm not Warren Buffett. I'm not looking at 5, 10, 15, 20-year time horizons for my trade ideas. I want to get paid at the end of the day, the week, and the month. And that is going to dictate my trading style and the strategies that I apply. Anyway, that's all for today. Thank you very much for your time and attention and making me a part of your regular routine. Have a wonderful day, and I'll speak to you at the same time next time. Toodaloo trader, bye for now. Keep in mind that futures, options on futures, stocks and stock option trading involve a degree of risk that may not be suitable for all investors. There is a risk of loss in every investment that you make, and it's your responsibility to assess the risks of your decisions. Past performance is no guarantee of future performance, and Antivestor provides educational information and does not provide financial advice.